Hello and welcome to the very first lecture on the module Mortgage Basics. So in this lecture, let's learn about what is mortgage banking, what are the different types of risk involved in mortgage banking. That's all. We are going to just learn about these three things. What is mortgage? Mortgages are the loans given to the consumers for the purpose of purchase, construction, or repair of the real estate. Mortgages were started in the year of 1930s by insurance companies in the US, primarily with the help of gaining the ownership of the properties if the borrower failed to make the payments on it. It wasn't until 1934 that the mortgages in their current form came into being. The Federal Housing Administration (FHA) played a critical role in this process. Mortgages can be broadly classified into four categories, like home, multifamily, commercial, and farm mortgages. Home mortgage is also known as 1 to 4 or single family mortgages. These are the mortgages provided for purchase or the construction of a home for occupancy of 1 to 4 families. These form the largest chunk of mortgage generated. Most of the subsequent discussion would be based on single family mortgages. So multifamily mortgages taken for the apartment complexes which house more than 4 families. And commercial mortgages, these are the mortgages that are taken for the development of the commercial property, including the shopping complexes, hospitals, and office complexes. And then the farm mortgages, these are the mortgages provided for purchase of the farmlands. What is mortgage banking? So mortgage banking generally involves loan originations, purchases, and sales through the secondary mortgage market. A mortgage bank can retain or sell loans it originates and retain, or sell the servicing on these loans. So you're going to understand what is this servicing or selling of the loans in the secondary market in the later sessions. So through mortgage banking, national banks can and do participate in any or a combination of these activities. Banks can also participate in mortgage banking activities by purchasing rather than just originating the loans. So the mortgage banking industry is highly competitive and involves many firms, and intense competition is there. The firms engaged in the mortgage banking vary in size from very small local firms to exceptionally large nationwide operations. Commercial banks and their subsidiaries and affiliates make up a large and growing proportion of the mortgage banking industry. When a bank originates a mortgage loan, it is creating the two commodities, a loan and the right to service the loan. So the secondary market values and the trades each of these commodities daily. Mortgage bankers create the economic value by producing these assets at a cost that is less than their market value. Given the cyclical nature of the mortgage banking and the trend to greater industry consolidation, banks must maximize efficiencies and the economies of scale to compete effectively. Mortgage banking operations can realize efficiencies by using systems and the technology that can enhance the loan processing or servicing activities. The large mortgage or servicing operations invest heavily in the technology to manage and produce and process large volumes of individual mortgages with a different or differing payments, taxes, insurance, disbursement, etc. They also operate complex telephone systems to handle the customer service, collections, and the foreclosures. This highly developed infrastructure enables mortgage banks to effectively handle the large and rapidly growing portfolios. Mortgage banking operations can also need the effective information systems to identify the value created and cost incurred to produce the different mortgage products. This is especially critical for the banks that retain the servicing rights. To optimize earnings on the servicing assets, the mortgage banks must have a cost-efficient servicing operations and effective integrated information system. This is very important for the servicer. That's why most of the banks, like big corporations who are involved in servicing, they invest heavily on the technology. All right, let's learn about what are the different type of risk involved in the mortgage banking. The applicable risk associated with the mortgage banking are like credit risk, interest rate risk, price risk, transaction risk, liquidity risk, compliance risk, and strategic risk and reputation risk. All right, let's learn each one of them in detail. First one is the credit risk. Credit risk is the risk to earnings or the capital arising from a borrower's failure to meet the terms of any contract with the bank or to otherwise fail to perform as agreed. So credit risk is the probable risk of loss resulting from a borrower's failure to repay a loan or meet contractual obligations. Traditionally, it refers to the risk that a lender may not receive the owed principal and interest, which results in an interruption of cash flows and increase the cost for the collection. Although it is impossible to know exactly who will default on the obligations, properly assessing and managing the credit risk can lessen the severity of the loss. Interest payments from the borrower or the issuer of a debt obligation or a lender's or investor's rewards for assuming credit risk. That's all about credit risk. What is interest rate risk? Interest rate risk is the risk to earnings or the capital arising from movements in the interest rates. It is one of the important risks where the originator or the mortgage banking is really has to look into that. It is the risk that an investment value will change due to a change in the absolute level of interest rates. Think of IRR as a blood pressure interest rate, as a blood pressure for the banks. It can increase or decrease without obvious outward signs, and such changes can cause the failure. At the same time, the regulators and the banks can monitor it and detect the changes. Finally, the banks can take preventative steps to manage the interest rate changes, but they do not want to eliminate it completely as it is. Like blood pressure itself is vital for human beings' survival. Third thing is the price risk. Price risk is the risk to earnings or the capital arising from the changes in the value of the portfolios of financial instruments. This risk arises from the market making, dealing, and position taking activities in the interest rate, the foreign exchange, equity, and the commodities market. What exactly is a high or a low price? Okay, so for most loans, you pay interest in return for the ability to borrow the money. With a risk-based pricing, you pay more or less interest depending on your risk or the lender's opinion of your risk. If you're a safe bet and the lender is all but certain you will repay, you will qualify for the best products all and lower interest rates. However, if you had some financial red flags in the past 7 to 10 years, such as the late payments, foreclosure, bankruptcy, or charge-offs, etc., you will likely not get the best interest rate. So if you have a good credit history but your income is marginal, you may also be considered risky. All right, so the next one is transaction risk. Transaction risk is the risk to earning or capital arising from the problems with a service or the product delivery. This risk is a function of internal controls, information systems, employee integrity, and operating processes. Transaction risk exists in all the products and the services. So this transaction risk is not just limited to the mortgage banking, but this kind of risk can exist in any other product or the services. Next one is the liquidity risk. Liquidity risk is the risk to earnings of the capital arising from a bank's inability to meet its obligations when they come due, without incurring unacceptable losses. Liquidity risk includes the inability to manage the unplanned decreases or the changes in funding sources. Liquidity risk also arises from the bank's failure to recognize or address the changes in the market conditions that affect the ability to liquidate assets quickly and with a minimal loss in value. What is compliance risk? Let's talk about compliance risk. Compliance risk is the risk to earnings to the capital arising from the violations of or non-conformance with the laws and rules, regulations, prescribed practices, or ethical standards. Compliance risk is also arises in situations where the laws or the rules governing retail bank products or activities of the bank's clients may be ambiguous or untested. Strategic risk is the risk. Okay, let's talk about strategic risk. It is a risk to your earnings or the capital arising from the adverse business decision or improper implementation of those decisions. This risk is a function of the compatibility of an organization's strategic goals, the business strategies developed to achieve those goals, the resources deployed against those goals, and the quality of the implementation. That's all about strategic risk. And the final one is the reputation risk. Reputation risk is the risk to earnings or the capital arising from the negative public opinion about your bank or your product. This affects the institution's ability to establish a new relationship or services or continue servicing existing relationship. All right, so so far we have learned about what is mortgage and what is mortgage banking as such, and what are the different risks involved in mortgage banking. So that's all for this lesson, and I will see you in the next lecture. Thank you.